Guys, happy Friday. It's good to see you.
Thank you. Good to be here.
How much time does the Fed have? Can we wait till Wednesday for some of these things?
Sooner the better. I don't know that it makes that much of a difference because at this point, you heard the probabilities. I think the market is correctly pricing in a big cut, probably something to zero. You know, my personal view is that what we really need to see here, I have actually probably more faith in the average person in the Fed getting this right. I think what we really need to see is the fiscal authorities get their act together and quickly. It so happens that they are working together. We've heard some positive comments from the Treasury Secretary this morning, but monetary policy can do only so much in this. I do think they're helping to unjam some of the plumbing problems that we've seen, but they're not going to help consumer spending very much. It's just the nature of the problem. That's where the fiscal response is so important.
And so what's being discussed in terms of the fiscal response, does it make sense? Is speed more important than exactly what's in here or how long?
I think they're both important. I think there's going to be a couple of different visits to this well. And the first visit looks like it's going to happen quickly, I hope. That's really going to be up to the Senate because the House is going to vote today. What's in it? It's going to have paid leave. It's going to have some unemployment insurance improvements, very important for people who, for example, might lack paid leave, so they're stuck at home but without a paycheck. It's going to have hopefully some fiscal relief for the states. And it's going to be relatively small in terms of magnitudes, hundreds of, millions, maybe single-digit billions. But it's just the first trip to the well.
Steve, in fact, the Treasury Secretary did say a couple times that this is a second inning kind of policy response this week. Walk us through some of the recommendations you wrote about.
Well, the main thing is that in a financial panic, money dominates. The fiscal thing is really a secondary thing. Everybody's pushing on the fiscal aspect, but you've got to get the monetary plumbing working properly so it isn't plugged up. And we've known this as a lender of last resort. That's what central banks are supposed to do. They're supposed to lend unlimited amounts against good collateral at penalty rates. Now, the only thing we don't have going is a penalty rate thing. They're all talking about running the rates down. But they got the big bazooka out yesterday, and they did exactly what John Greenwood and I recommended that they should do in our Tuesday Wall Street Journal editorial. They let it fly, and they should continue to discount anything that is good collateral at penalty rates and provide the liquidity. We did not do that in the 2008 and 2009 period. We did just the opposite. You had Leisman come on. He alluded to these things. The bank regulations that were put in with Dodd-Frank and the Basel III capital requirements all were pro-cyclical. They made the Great Recession great. And then at the end, you had Lehman Brothers, which was solvent, and the Fed refused to extend credit to a solvent financial institution, and that was the killer. So I have less faith in the Fed doing the right thing after the Lehman fiasco, perhaps, than Jared does. But at least right now, they're right on target. They're doing exactly the right thing.
So I think that the key thing here is I really think you need to flip the usual fiscal monetary kind of sequencing in the way we tend to think about this. I completely agree with Steve that getting the plumbing, especially in the Treasury market, back up and running is essential. And I think the Fed's on the case, and we'll see. But lower interest rates all you want. Make them negative, and people aren't going to be able to go to basketball games, and they're not going to be able to go to the theater, and they're not going to be able to go to restaurants. This is a very unique problem that we face. And there are literally millions, I would say between 20 and 30 million workers out there who have no paid sick leave. If they get laid off, they don't get a paycheck. They don't have savings to fall back on. I think it would be a big mistake to underestimate the importance of getting the fiscal stimulus out there quickly.
Well, I think it
what
depends.
About the criticism? Yeah, Steve.
I think it depends on the kind of fiscal stimulus.
I
like the plain vanilla variety, as they're doing in Hong Kong. They're emitting 10,000 Hong Kong dollars to every citizen of Hong Kong. That's about $1,300. It's just cash. You give them cash, and you do it immediately. That's the way to do this kind of thing.
We've been saying this all week. You don't want that cash to go to the insurance company for the test, right?
Yeah,
How much
some
responsibility does the
bureaucrat.
private sector have to support?
If you
So I
look
think
at
the private-
if you look at the Great Depression, for example, we had a lot of fiscal stimulus and the programs that went in and the bureaucracies, and you get what is called the ratchet effect. Those programs, we still have them. The Great Depression was a long time ago.
Steve, hold on, Steve. You're making some good points. Hold on. Let me just say, I totally agree with Steve. Checks to households ought to be a top priority. And by the way, you know who did that last was Bush 2 in 2008. So that ought to be a bipartisan thing. But yeah, look, the insurance companies, I think that they ought to step up. This is a national emergency on the healthcare side. And we're lagging behind other countries in this regard. I also think that if people are facing eviction because they've missed a couple of weeks of work, that we might have to ask landlords to step up. I think the private sector has a role to play here.
Guys, thank you very much. Good to talk to you both. Good to see you again, especially
Thank
Jared.
you.
We got more.